Hi there, everyone, and welcome into this week's market update. Now, don't forget that any advice contained within this presentation is general only, so it isn't tailored to your particular circumstances. You need to decide for yourself whether it's appropriate to you. Okay, our market closed off the session fairly flat, and this is despite the RBA lifting rates by another 0.5% today, showing that the market really has started to price those RBA interest rate lifts in at this point of time. So, looking at the market overall, we're quite a distance from the highs. Okay, all-time high all the way up here. To current price, we're about sitting at about 13% lower. We're faring a little bit better than obviously some offshore markets. Obviously, our exporters have done extremely well this year to hold us up, but have started falling. A lot of our miners are quite a bit lower at the moment. So, keeping an eye on that space heavily, and I'll talk to that a little bit more in a moment. All right, so what have we got here in the short term? We've got a potential higher trough here now. Okay, so this trough is potentially higher than that. We want a break of this pennant to confirm. And really, before we start talking about change of trend or anything like that, we need to break above this sort of peak through here as well. And we'd want to see a few other signals as well. So it's too early to say that this is the bottom. I think we're pretty close to the bottom, to be honest, guys, here, unless inflation gets out of control again. If crude continues to rise and starts jumping to 120, 130, 140, and I'll change my tune. But what we're seeing right now is definitely some calm, right? Commodities have pulled back a lot. So copper, iron ore, wheat futures, a lot of other agricultural futures markets have come back off quite a bit. And we should see that starting to flow into inflation data a little bit later this year. But there's definitely a sense that things are cooling off out there as the central banks are starting to jump rates up. So it'll be interesting to see if this continues to be the theme in the next few months and whether this does end up being the bottom or not. I dare sort of say we're getting close, right? Given what we know right now, and happy to change that view on a dime if that sort of energy space starts changing again. Getting across the S&P 500, you can see clear downtrend in play. Their market's been hit a lot harder than many others have, right? So we're sitting, at this stage, or to the lows, they hit almost 25%. They've made up about 5% of that and still sit about 20% below their highs. Similar scenario, you've got a potential of a higher trough here, but, a breakthrough sort of 4,000 is key, thereabouts, 39.50, thereabouts. That's key, guys, right? That to me starts sort of saying potential change of trend back to up, or you might have a bit more of a relief rally back up to 4,200 or something like that, right? But at this point of time, we're kind of back at that pivot point again. Is this the bottom? Are we going to see further downward movement? Are we going to start seeing a turnaround? Well, it's all going to be news dependent, right? And that's kind of that's the message we're getting from central banks and what they're going to do next. Hence, what the market's likely to do next is going to be very, very much data driven. Okay, so let's start talking about the RBA. They lifted rates by another 0.5%, brings the official rate to 1.35. Huge jump from near zero that we had a couple of months back, guys. Right? So they're lifting rates at an extraordinary amount very quickly here, and their commentary behind it is they're trying to get rates back to a neutral stance and unwind some of the extraordinary measures they put in place coming into the pandemic. Now, I love this, right? So, the funny thing is, right, interest rates were going down before the pandemic even began, and I just got to call it out here. The Fed was already talking about negative rates before the pandemic, right? Before the pandemic, because guess what? We had a deflationary issue. They couldn't work out how to liven up the economy again. And the pandemic actually ended up being a really good excuse to flood the market with stimulus, and it would have worked. Guys, it would have worked. The biggest problem and the thing that none of us really predicted coming into this year was the supply chain was going to be an issue, and that the inflation wasn't going to come back down. And I think many of us were expecting the supply chain to reopen as the rest of the world was reopening rather quickly, and it wasn't the case. Okay, it wasn't the case. And then you throw in, complications around Ukraine and Russia. Don't get me started with that, with the price of oil, and we got this so-called inflationary problem. So, look, I still think it's transitory in a sense, okay? That supply chain issues could still resolve over time. It's just could take a few years, right? So let's just see what happens here, guys, okay? It's going to be this tug of war over the next few months of central banks lifting rates, okay, to bring inflation down. We need to see inflation come down. As that's happening, we're going to see weak economic data. We're going to see potential recessions. A lot of people are now predicting the US will go into recession, or is in recession now. We just need the official GDP reading for the second quarter, and we'll get that towards the end of the month. So, US is likely to be in recession. It's quite a bit of a negative sandwich out there at the moment. The only light at the tunnel I'm seeing really is commodity prices falling, which then takes the pressure off inflation, and we might find the top of inflation sooner rather than later. We need the central banks to finish this rate hiking cycle. They're going hard at it really quickly, and it's creating a lot of fear. And I think that's obviously the desired result. Um, Markets have more than just corrected here. They formed downtrends. It's just whether those downtrends will continue and this becomes something much larger, like the 2000 crash or the GFC, or whether this is it and things will calm through to the end of the year. We'll wait for our signals to determine that, and that's for me going to come down to inflation and how much harder these central bankers are going to go. Right, so there's such a broad mixture of views out there. There's a lot of people calling it to 2.5%, which is fairly neutral. There's people expecting it to go to 3.5%, 4% on the RBA rate. I can't personally see it going that far here in Australia. If they went up to 4%, that means people would be paying 6% plus on their variable rates. Most home buyers that have bought in the last 2 years will be out of the market, selling their properties, and unwinding everything, right? Because there's no way a lot of these poor first home buyers that have bought in at 800,000 going to be able to afford those types of repayments. So, look, I can't see it going that far, guys, unless inflation does continue to get out of hand, right? I think this is a bit of a scare tactic, obviously, by the central banks to cool things off and bring demand back down. So I expect another 0.5% potentially in August from the RBA. All right, that will bring them up closer to 2%. Looking at the 1-year government bond yields, they're trading at about 2.4 at the moment. So it depends on what you want to look at, but that's what I like to look at. And that to me suggests that we're filling the gap. Okay, so by perhaps October, September maybe, these central banks may have finally gotten up to a point where they can stop going so hard, right? They can slowly turn back to more of a neutral stance rather than being so hawkish. So that's what we're looking for. I think that's going to really dictate how quickly we find the bottom or how rough things get. If they keep hiking all the way up to 3%, the market's going to tumble. Right, it's going to tumble. I just can't see that happening at this point of time. And for me to warrant that type of movement, you're going to have to see crude much higher than what it is right now. Okay, so yeah, that to me is the main thing to look out for. So commodities. On that note, look, we've seen a massive correction in commodities. Iron ore's, fallen back down to about 109 US a ton. We've got steel demand falling off. Copper's fallen off, 20 odd percent. You got things like wheat that's fallen off like 25%. So all these commodity markets are starting to really correct and come back down again, which is going to take the pressure off inflation. But at the same time, it's actually hit the miners and exporters pretty hard in our market. Hence why we've been a bit fair, we went from being resilient to not being resilient anymore, was that turning point. So, there's definitely for me some short-term pain here as commodities correct to the downside, as people pricing in US recession and things like that. So there's still some downside potential here, but I do think that we've already seen 10% corrections in our market this year happen very quickly. Okay, I'm not sure whether we're really going to see another one unless we start, seeing inflation get back out of hand again. So I sort of think that the markets are close to a bottom at this point. Considering we're seeing commodities fall off, that should take pressure off inflation. That's my forward indicator at the moment. But to find the real bottom is probably still 2 to 3 months off. We might have to create sort of one of those inverse head and shoulders or a double bottom. It's going to be a W type shape recovery, guys. It's not going to be a COVID V shape where it just went down and straight back up. It's going to be sort of one of these whippy behaviors where the market's going to whip around for a while. Think about it before it's going to start forming that uptrend, and that's kind of how I'm feeling at the moment. Volatility to come, but more maybe sideways-ish rather than this huge fall off that we've been seeing recently. So we're seeing a lot of buying in the bond space of recent, and that sort of marks to me that people are expecting things to cool down. Okay, so demand's going to cool off, inflation's going to cool off. In that environment, you're buying into the high bond yields, right? If you can secure, you know, a 10-year bond for 3.5% out of the US, well, why wouldn't you, right? So that's kind of the attitude right now. We have seen up until maybe this morning a lot of money flow towards bonds at the moment. Okay, so overnight into this morning, we saw a little bit of selling and yields come up a touch. But we've got US 10-year back below 3. So that's a good sign for me. I think that's pressure coming off inflation. That's people maneuvering their money around, and if they're seeing value at 3.5%, they're probably thinking that it's not going to go much higher than that. So I think once again, we're finding the bottom in the bond market, and I think that's going to translate to finding a bit of a bottom in the equity market over the next few months. With the caveat that we want to see energy prices remain fairly subdued as well. So they're the main things that we're looking out for. So next week, this is fairly important. US reporting kicks off. This gives us an opportunity as well to see sort of under the hood of these companies and how they've gone over the last quarter, as things have probably slowed down, and you most likely either have really slow growth, GDP growth in the US, or even negative GDP growth again for the quarter. So we're going to see under the hood. It gives us opportunity to go, okay, where's the share price at versus earnings? What are they projecting for future earnings? And let's get some forward guidance on that, and just get a feel for where price to earnings looks like on some of these good, beautiful, awesome US companies that are on sale, right? I guess the way I'm seeing it, guys, is I'm 50% cash in my portfolio at the moment, right? And I'm looking to get in. It's just when am I going to get in? I feel there's a lot of people in this situation right now where they've cashed out of the market because it's volatile. They've either gotten right out or they're 20% cash, 30% cash. In times like this, you've got a mandate. Most portfolio managers have a mandate to have a certain percentage of cash. And when you're sitting on that cash, you're looking at the market every week going, what am I going to buy? Here's my shopping list. Okay, I have my shopping list. When am I going to buy it, right? So there's an element of that I believe that's going to come in at some point over the next few months. Okay, I'm never going to try and call a bottom, guys. Right? It's going to happen when it's going to happen, and you've got to be ready for it. Okay, and for me, it's about where's the top of interest rates. Okay, for me, it's where's the top of inflation, and then I'm looking for certain technical signals to help me get in as well. So there's this kind of a combination of fundamental and technical reasons why I'd want to try and call this the time to get in and start buying, right? Okay, so US reporting, another key bit of information next week that we're looking for to help us recognize which companies we're going to be buying, but also when, right? So next big bit of news as well is next week. So next week's a big week for me. You got US reporting. You got US CPI on Thursday morning, late Wednesday night for us, and that's the big one, right? So if inflation comes in slightly lower than expectations, I think we're going to see a move back towards some equities, right? Especially some of the discretionary stocks and tech stocks that have been beaten down so much. I think inflation data next week is incredibly important, okay, for the overall mood of the market. So watch out for that, guys. That's our next big bit of news, next big catalyst for a potential move, either up or down, right? The last CPI reading sent markets flying lower, okay, because then, it gave reason for the Fed to lift by 75 points. This CPI reading is going to be much the same, okay? It's a couple of weeks before the Fed, and if if that inflation data is high, it gives ammunition for the Fed to go another 0.75 or even 1% higher. Who knows, right? So, that's what it comes down to, right? That's what it's going to come down to. So that's where we're at, guys. Look, it's definitely a lot of negativity out there, and I'm seeing a lot of extremely negative articles appear. I think there was one on the AFR today talking about the fact that asset prices have peaked for the next generation, or something like that. When I start hearing extreme comments like that and extreme headlines, it cements even further that we're close to the bottom, right? When things start getting to extremes, that's usually when we're close to the bottom, guys. I hate to say it, right? But it's usually the case. Um, so to me, there's green shoots. There's definitely some signs that we're close to it, and I'm just looking to confirm that with a bit more data, and want to see where the end of this rate hiking cycle is, and then be happy to slowly start getting back in again. Right? Okay, so that's where we're at, guys. Okay, thanks for listening in. Take care, and bye for now.